What if I told you that every single price level we mapped out, the exact entry, the exact ceiling, and the exact breakout, all played out with almost surgical precision? And what if the move that just happened is not the end of the story, but actually just the opening act of something far bigger? Welcome back to Smart Stock Sam. I am your host, and today we are going inside the machine behind AMC Entertainment's explosive price action. We are going to reveal a full squeeze blueprint with a potential path toward $3 per share. And more importantly, we are going to show you exactly why this is not random noise. We are going to break down the debt trap, the options engine, the dark pool setup, and the institutional battleground, all in one place. Stay locked in from beginning to end, because in the next few minutes you are going to understand why AMC is right now the most structurally charged momentum trade on the entire market. Let's get into it. Before we talk about where this stock goes next, we have to acknowledge what just happened, because the market just executed something that almost never plays out this cleanly. Back on June 8th, we laid out a very specific blueprint right here on Smart Stock Sam. We identified a tight entry zone between $1.75 and $1.78, anchored to the critical 5-day moving average. The market bounced at exactly $1.79, not $1.60, not $1.90, $1.79. We then warned you that the $2 strike was a massive wall of call options acting as a concrete ceiling that would need to be destroyed before any real rally could begin. The stock tested that wall, got rejected, and then, on June 10th, it bulldozed straight through it on enormous retail volume. And once that ceiling cracked open, the mechanical buying kicked in exactly as described, sending the stock into a full breakout that peaked at $2.41, completely surpassing our $2.21 stretch target. This was not luck. This was not a coincidence. This was institutional money flow mechanics revealing themselves in real time. When you know how to read the map, the market tells you exactly where it is going. And right now, the map is pointing somewhere even more interesting. So, what actually fueled this incredible 80% rebound from the mid-May lows near $1.25 all the way to a close of $2.34 on June 12th? Right now, I am officially classifying AMC as a speculative buy. And that classification is built on 4 very specific converging catalysts. First, a record-breaking box office return unlike anything we have seen since before the pandemic. Second, the market's extraordinary absorption of a $150 million equity offering that, against all logic, sent the stock higher instead of lower. Third, aggressive and highly convicted insider buying directly from the CEO himself. And fourth, a renewed wave of intense retail speculation that injected massive liquidity almost overnight. When these 4 forces hit at exactly the same time, you do not get a random pump. You get a structured, catalyst-driven setup that carries real mechanical momentum heading into the week of June 15th. It is the kind of rare alignment that professional traders spend entire quarters waiting for. And right now, it is sitting right in front of us. What happened between June 8th and June 12th was a textbook squeeze sequence, almost like it was written in a trading manual. From June 8th through June 10th, the stock coiled quietly around $1.80, building energy like a compressed spring. On June 10th, it shattered the $2 psychological barrier, closing at $2.08 on over 42 million shares traded. Now here is where it gets truly remarkable. On June 11th, AMC announced the completion of a massive 105.3 million share dilution to raise fresh capital. Normally, in almost every other situation, that kind of dilution is an instant death sentence for near-term momentum. Funds sell, algorithms panic, retail flees. But what actually happened? The market absorbed every single one of those shares, shrugged off the dilution, and then the stock rocketed to $2.32 before closing at $2.28 on a staggering 59.8 million shares of volume. The bulls did not just hold the line, they completely overpowered the new supply. and that demand carried right into June 12th, where the stock gapped up and hit that $2.41 peak before settling at $2.34. When buyer demand overwhelms a massive dilution event like that, you have to ask yourself, what do these buyers know that the headline readers do not? Here's what they know. The microeconomics of the actual theater business are suddenly and genuinely flashing green. May of 2026 saw 25.5 million global guests walk through an AMC door, the highest May attendance since before the pandemic back in 2019. Memorial Day weekend alone pulled in over 5 million moviegoers globally, with blockbuster demand for Project Hail Mary delivering $80 million domestically and $140 million globally on opening weekend, alongside the massive pull of The Mandalorian and Grogu. But here is the most interesting strategic shift. AMC is now deliberately delaying their alternative content programming specifically to maximize screen availability for these high-grossing blockbusters, and simultaneously, they are rolling out a higher-margin feature-fare food menu to over 400 United States locations, more guests in seats, more screens devoted to the highest-earning content, higher-margin food in their hands. This is not a company in freefall. This is a cash flow engine that is actively restarting. Now let's talk about the corporate catalysts, giving this company the financial runway to survive long enough for that recovery to actually matter. The $150 million equity offering, completed on June 11th, was not a desperate act in the eyes of the market. It was a survival move the market chose to reward. The stock rallied over 10% on the very same day the dilution was announced. Investors essentially said, yes, we understand the new shares, and we are buying anyway. On top of that, CEO Adam Aron publicly threw his support behind the massive Paramount-Warner-Skydance merger, and the reason matters enormously. That deal guarantees a minimum of 30 theatrical releases annually and enforces a strict 45-day theatrical exclusivity window before any film moves to streaming. Do you understand what that means for AMC? The streaming threat, the existential fear haunting theater stocks for a decade, gets structurally limited by a contractual wall. Adam Aron is not just running a company, he is building a defensive moat around it. And the macro environment is cooperating in a way that almost never lines up this perfectly. United States producer and import price data recently came in cooler than expected, signaling easing inflation. Geopolitical tensions are showing brief signs of cooling, with proposed ceasefires helping ease global oil prices. When inflation falls and gas is cheaper, the average family suddenly has more discretionary income sitting in their pocket. And what do people spend discretionary income on? Entertainment, Friday nights at the movies, fueling the speculative fire even further. A highly viral and unverified post connected to an associate of the legendary Roaring Kitty circulated widely on June 10th. Whether the rumor was true or not is almost beside the point. The liquidity it detonated in the stock was absolutely real. In momentum trading, real volume is the only currency that matters. And that injection of retail energy on June 10th shifted the entire tone of the tape in a matter of hours, proving once again that sentiment and mechanics are equally powerful forces. But before anyone gets too carried away, and I mean this with complete seriousness, we need to draw the single most important line in this entire conversation. There is a firm wall between a short-term momentum trade and a long-term fundamental investment. AMC, as a long-term hold, carries enormous and undeniable risk. The company just posted a net loss of $117.1 million, with negative free cash flow of $174.7 million, and sitting over all of that is a debt load estimated between $7.3 billion and $7.9 billion. Until attendance genuinely converts into sustained positive free cash flow, the risk of further dilution never fully disappears. Do not mistake a mechanical squeeze for a balance sheet recovery. As a short-term momentum trade driven by options mechanics and retail energy, this is one of the most powerful setups on the board right now. As a 5-year buy and hold, the risk profile is in an entirely different category. Keep those two realities completely separate at all times. So what are the biggest players actually doing with their money? The institutional picture is one of the most polarized setups I have seen on any individual stock in recent memory. CEO Adam Aron just personally purchased 250,000 shares in the open market at an average price of $1.38. That is a $345,000 bet of his own personal money, bringing his total holdings to over 2.4 million shares. Executives sell stock for 1,000 different reasons, but they only buy for exactly one. They believe the price is going higher. On the institutional side, approximately 31.87% of the float is currently institutionally owned, but the composition is shifting. The Vanguard Group completely exited a massive 30 million share position. But stepping directly into that void, Triumph Capital Management increased their stake by 139%, and the Royal Bank of Canada boosted their holdings by over 90%. Vanguard out. Aggressive growth money in. That is a rotation, and rotations always tell a story. The analyst community is equally divided. On the extreme bearish end, Citigroup maintains a price target of just $1.20. B. Riley Securities sits at $2.25. Benchmark recently upgraded the stock to a buy rating with a $2.50 target. And at the bull end of the spectrum, Wedbush carries an outperform rating with a $3 price target. With the stock sitting around $2.34, it is parked right in the absolute center of this battleground. Here is the question you should be sitting with. When analysts are this divided, what almost always happens to a stock sitting in the middle of that disagreement? Massive, sustained volatility. And in the right trade structure, volatility is not your enemy. It is your fuel. The wider the analyst disagreement, the more explosive the resolution tends to be when the market finally picks a direction. The technical dashboard right now is flashing 12 active bullish signals. The price of $2.34 sits comfortably above the 5-day, the 20-day, and the 50-day moving averages. More importantly, AMC has successfully reclaimed its 200-day moving average sitting way down at $1.66. The 14-day relative strength index is reading 64.24, firmly inside the bullish momentum zone, but not yet above 70, meaning this rally still has technical room to extend without being overextended. The MACD indicator has confirmed the upward trend with a bullish crossover at 0.094. Every standard technical metric is aligned in the same direction. When that happens, when the moving averages, the momentum oscillators, and the trend indicators all point the same way simultaneously, the probability of continuation rises sharply. Now let's go deeper into the dark pools, because this is where the real explosive potential is hiding beneath the surface. Right now, there are over 59.08 million shares currently sold short, representing approximately 8.52% of the float. But look at where the shorting is actually happening. We are seeing extreme off-exchange dark pool short volume sitting at 30.14%. On June 11th alone, nearly 10 million shares were shorted through dark pool channels. And because the stock borrow fee remains exceptionally low, sitting under 0.5%, shorts are sitting comfortably with virtually no carrying cost pressure. Here is the question nobody is asking loudly enough. What happens to all of those comfortable short sellers if this stock breaks through 250 on high volume? Forced covering cascade. Complacent shorts make for a far more violent squeeze when the trigger gets pulled. This is a powder keg sitting directly beneath a lit fuse, and that fuse connects directly to the options chain, the gamma engine that will mechanically drive the next leg of this move. For the June 18th options expiry, there are 1.17 million total open interest contracts across the board, creating enormous delta hedging obligations for market makers. Down at the $2 strike, we now have a structural support floor holding over 90,000 open call contracts. Last week, $2 was a ceiling. This week, it has flipped into concrete support. Moving up, The first major battleground is the $2.50 strike, holding over 79,000 open calls. Above that sits the ultimate magnet, the $3 strike, holding nearly 48,000 open calls. These strikes are not just numbers. They are gravitational forces pulling the price mechanically upward as market makers continuously rebalance their hedges on every single uptick. Here is the exact blueprint for capturing the continuation move between June 15th and June 19th. Your entry zone is between $2.20 and $2.25, aligning perfectly with the 20-day moving average and key pivot support. Your hard stop loss is $2 even, with an absolute floor at $1.90. If a daily close falls below $1.90, the entire bullish thesis is structurally invalidated, and the trade must be cut without hesitation. To the upside, first target is $2.41, testing the recent multi-week high. Target 2 is $2.50, aligning with the options battleground and the benchmark analyst price target. Expect serious resistance there, but ask yourself this. What if retail does not just test 250, but absolutely obliterates it on massive volume? In that scenario, we enter the $3 stretch target. A clean break above 250 triggers aggressive forced buying from market makers managing their delta exposure, mechanically pushing the stock toward Wedbush's $3 target. That is not speculation. That is options math. The conclusion is this. AMC right now is the ultimate high beta catalyst play. On the reward side, a genuine box office recovery that is statistically real, aggressive insider conviction backed by personal capital, a fully cleared $2 options wall that has flipped from ceiling to floor, and a gamma engine pointing squarely at $3. On the risk side, a $7+ billion debt load means this is a trade to be managed aggressively, not a position to be held passively. Engage with AMC strictly as a high volatility momentum trade. Respect the $2 floor as your absolute line in the sand. If the options math holds, the mechanics are firmly in your favor. Now, before we close, here is something I need to say clearly. Nothing in this video is financial advice. Everything presented here is purely for educational and informational purposes only. AMC is an extremely high-risk, highly speculative stock carrying massive debt and negative cash flow. Always conduct your own thorough due diligence. Consult a licensed financial advisor before making any investment decisions, and never risk capital you cannot afford to lose entirely. The market can and will move against any thesis. Manage your risk accordingly. All right, that is the full breakdown for you today on Smart Stock Sam. Now here is the question I want you to genuinely think about and drop in the comments. If AMC clears 250 on strong volume next week, do you believe the Gamma engine has enough structural fuel to push it all the way to $3? Or does the weight of that debt overhang ultimately crush the rally before it ever gets there? I want your honest take below. If this breakdown delivered real value to you today, smash that like button. It genuinely helps more people find this content and keeps this channel alive. If you are not subscribed yet, hit subscribe right now so you never miss a blueprint like this one. You can also support this channel directly by sending a super thanks using YouTube's built-in support feature. Every single one truly means the world and keeps this work going. And one more thing before you go. I have launched an exclusive Smart Stock Sam membership community right here on YouTube. Members get early access to trade setups, deeper breakdowns, priority replies to their queries, and a tight-knit community of traders who are all leveling up together. The link is right below this video. Come join us, level up your trading and investing, and let's build this together. I will see you in the next video.